This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. It's an important morning after an important event last night. We're coming to you, as always, from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Sonia, and Surabhi is with us today as well. Guys, hi, good morning.
Hi.
Good morning, guys.
Good morning. Well, so much to reckon with this morning. Of course, what happened with the US Fed, the pause and the expected, rate hikes, etc. But before anything, I just want to mention that Cyclone Biparjoy is, the update on that is that the Indian Navy is in standby in view of approaching the cyclone. And at this point in time, I think it's expected to hit Kutch very soon, and of course then move towards Pakistan. So hopefully everyone stays safe. Hopefully all the rescue operations pan out as planned, and there are no major issues, injuries, casualties, etc.
Absolutely, absolutely. By the way, Surabhi, I think, was awake last night, Sonia, watching the Fed and parsing through the statements, etc.
I'm promising I'm turning a new leaf. I decided I would only look at things at 5 a.m., which is what I did, Prashant.
Prashant, that's your forte. That's what you do generally.
The last I did it was during the global financial crisis. I stayed up many nights, I can admit, but that's a long, long time ago.
Yeah, even for me, it was just this mini banking crisis of sorts that we had. That's the only reason. Otherwise, we'll deal with the Fed.
All right, well, let's just get down to it in terms of what you need to know. Now, it was a peculiar pause from the Fed. It was an expected pause, but I'm calling it a peculiar pause, and I'll tell you why. There was no hike in June, but it was almost as if to make up for the no hike, they kind of went, not overboard, but they went excessively hawkish. They said, well, they clearly said that there are two more hikes which are penciled in this year, in 2023. Now, that is, more hawkish than what anybody really thought. The terminal policy, which is where the Fed, the rate will peak off, according to their own projections, now stands at between 5.5% to 5.75%. And the outcome is more hawkish than most mainstream economists out there. Actually, people will now, after this, and it's peculiar because they'll have to do this on a meeting in which they did not do anything. Most economists will have to take up their expectations of the terminal rate a little up. Some by 25, some by 50 basis points or so. And that's the reason why I'm saying that this is a little more hawkish than what many expected. Now, US markets, right? The reaction is always interesting on days like this. They sold off. You had yields which ran up very, very sharply. You had stocks which sold off. But by close, there was a big recovery which essentially was afoot. So from the intraday lows, it was a flat close day on day. But from the intraday lows, the S&P recovered about 0.8%. The Nasdaq recovered 1.2% or so. Market interpretation changes. By the way, it doesn't just change during when this is happening, but usually, what I've observed is, on day two, sometimes the reaction is dramatically different as compared to the D-Day, on the day in which, you have a big data point or the Fed decision, etc. But more on that in just a bit. The two-year Treasury yield, this is the closest to what the Fed rate is. In terms of behavior, it moves the closest. It ended at 4.69%, some 13 basis points off the intraday high. So as we got into the market close, the market perhaps thawed a little bit, and they were a little less panicky going into the close. Now, what does this mean for us here in India? As I said, we are very close to all-time highs. We're 160, 170 points away as of yesterday's close. We've also yesterday had a nice rally which left us just under the previous high, which is 18,778. We left off at 18,755, so just 30 points away. So that kind of becomes the first kind of, not resistance, but that's the first level to take out on the way to the next 100 points, which will get us to the all-time high of 18,887. There's not very much in terms of, you can look at hourly averages, etc., but there's no point. You're just there, almost there, in terms of a new high, less than 1%. On the way down, of course, the distance is more now, but 18,555 is important, and the 20-day moving average of about 18,500 will be levels to watch, which will need to be defended if there is any shakeout which starts to appear. On the banks, the bank nifty is pretty much stuck in a range. So once again, for the third or the fourth day, it closed around the 20-day moving average, which left off at 44,003. We left off at 43,988. The 20 days at 44,003. So the 20-day is the first kind of level to defend on a closing basis. You don't want a meaningfully large close under it. And then the recent low of 43,874 will be important. On the way up, I mean 44,500, 44,499 is the level to take out on the way for the Bank Nifty to actually accumulate more gains. But I would say this, I mean, the SGX, I think, is not showing us very much in terms of activity. Nothing has really changed in that sense. The reason why the Fed paused and it's indicating more hikes is the fact that it is seeing the US economy to be in a pretty good and stable kind of shape. Here in India, I mean, you can argue that maybe the recent rally has been very feverish, so people are concerned about the pace of the rally, but fundamentally not very much has changed. So the date with the new all-time high is still very much there. But if you're trading very short term, as I said, sometimes the reaction is on the day of the decision, but also on the second day, because the market starts to come up with new theories about what they said and what it could mean, and projections change, etc. So be careful. No need to chase if you get a sharp. I mean, if this changes dramatically, if you get a sharply higher start, no need to chase it. If this extends a little bit more on the downside, then maybe that gives you a better entry opportunity by 9:15. So 18,806 is where the SGX is indicating an opening at. Sonia.
Absolutely. And the market has rallied for quite a bit, right? I mean, It's been 3 straight days of a rally up until now. So some caution perhaps won't harm anyone. Given that, having said that, this has been a buy on dips market. So eventually, of course, it's just a matter of time before we get to all-time highs. Remember, it's been a smooth run up until now. The Nifty is up almost 11% from the lows that we saw in the month of March. And now we are less than 150 points away from all-time highs. So it's just a matter of time before we get there. But purely for today, some caution could be taken on board, given the kind of run-up that we've seen. However, foreign investors continue to buy in cash, and 3 days running now, the numbers have been pretty large. Yesterday as well, FI has bought almost 1,700 crores. Put together, it's over 6,000 crores of buying in just 3 trading sessions from foreign investors. All the domestic institutions have sold about 650 crores. So the money flow is coming in quite well. Now, just one word on the US Fed. A lot has been said, of course. The Fed has held off on rate hikes, but they've also said that 2 more are coming this year. And they've said they will take another 6 weeks to see the impact of the policy moves and whether inflation is under control. So you never know which way things could head, and that could bring about some amount of uncertainty in the market as well. Now, in stock action today, I'm watching out for a couple of things. One is Axis Bank could be in focus because sources indicate that Bain Capital is likely to sell stake up to $267 million in a block deal. So keep your eye out on that. The 2 other pockets which have been doing very well and have come out to be leaders of this market. One is autos, of course, new highs, day after day over there. And the other is metals. The Nifty Metal Index has come back in a big way. And yesterday as well, we saw some big moves over there. In fact, for the month of June so far, JSW Steel is the biggest index gainer. It's up almost 11%. So I'm going to keep my eye out on that pocket as well. But give and take everything, the SGX Nifty is hinting a muted start. And we've had 3 days of gains under our belt. So perhaps some cooling off would not harm anyone.
Perhaps, yeah. I think we saw a bit of that caution already start playing out yesterday. And the large cap space was muted. We didn't have a wild mid cap rally as we've seen in the last couple of days. Yesterday was quite a day for mid caps as well. By the way, just want to point out the action on the currency and rates market as they also digest what really the Fed is indicating. And Prashant, completely take your point. Many times we get the real sort of follow through or the real reaction a day later. So let's say futures right now, Wall Street futures are mildly negative. The dollar is higher. It dipped below 103. It's gone above 103 again. And the 10-year yield has now inched up to the 3.8% mark. So let's see how the markets kind of parse through all the announcements and the trajectory from here on in the July meeting. So that's as far as the global picture is concerned. Speaking of central banks, while the Fed is sounding a hawkish note, the Chinese are going ahead with their cutting plans. Now, what we've seen is there's a rate cut in the medium-term lending facility, the 1-year lending facility in China. PBOC announced this just earlier this morning. This follows up on the 10 basis points rate cut that we saw on the 7-year reverse repo earlier this week. So this one also is just a 10 basis points cut, but it's indicative of the mood and the mindset perhaps in the Chinese market. It is the first such cut in 10 months. We know what happened to the metals market and what's been happening. Just want to put things in context. I mean, the Nifty is up just about 1.2% so far in June. The metals index, the Nifty metals is up almost 5.5%. So this wild rally which is entirely based on stimulus hopes from China, that continues unabated. So let's see if we'll get any follow through today or not, because while the Chinese Q is positive, the Fed Q is negative. That's where there's lack of clarity on what the Western central banks are going to do. So that's something to watch for. Just want to also point out the FII numbers. Didn't mention this. Should have put this up on the data board as well. We had almost 48,000 crores of flows come in the month of May. So far, we're halfway down June. That number's come down to 11,000 crores. We need to watch for the flow situation as well, incrementally, whether June is going to be as huge a month as May was. Finally, on stock-specific action, we'll watch out for the HDFC twins. Now, there's been a lot of chatter in the market since yesterday. There's been a Reuters report suggesting that there is some disagreement between SEBI and AMFI, the mutual fund body, in terms of how you will look at MF holdings on HDFC Bank when the merged entity starts trading on the exchanges, which should happen in just a couple of weeks from now. The sense that we are picking up from the mutual fund fraternity is that they're saying there's no need to panic. This should be fairly managed because there's a 30-day window that's being offered from the day of the merged entity listing and trading on the exchange. MF seem to be suggesting that 30 days will be enough to do a rebalance. It shouldn't lead to too much of market volatility. AMCs can do this rebalancing within their own schemes as well, though it will have to go through the exchange. There will have to be order matching. Anyway, short point, the MF view right now is there's no need to panic. This should be well managed without excessive volatility on these stocks. But of course, we'll have to wait and watch and see how that plays along. So I guess, folks, plenty to keep us busy all through the day today.
A long, long day ahead, right? But I think for the market, one event is out of the way. Yeah. So perhaps they can decide which direction they want to take. By the way, a lot of Asian markets are doing quite well this morning. So Hong Kong is up almost 1%. China is well in the green. So let's see how our markets take that forward. But on the Fed decision, we have a comment coming in from Eric Fishwick of CLSA, who says that the Fed left rates unchanged at 5.25%, but raised its guidance for encompassing rates at 5.75% by 2023 end. They raised their terminal rate forecast to 5.5%, but expect the last move to 5.75% will be unnecessary.
Okay, some more views coming in. This is on equities. Mahesh Nandurkar of Jefferies says the headline Nifty earnings growth projection of 20% for FY24 appears high, but a slowdown in domestic earnings growth from 30% in FY23 to 19% in FY24 is already built in. Margin expansion is an earnings driver and has added 5 percentage points to FY24 earnings growth. Auto, staples, cement and metals are expected to see the biggest margin improvement, primarily on decline in cost pressures. We stay overweight in domestic cyclicals, financials, property and industrials.
All right, let's also get you some money market views this morning. On the rupee, Parul Mittal Sinha of Standard Chartered Bank says the dollar INR slipped below the critical threshold of 82.10 to 82.20 on the weaker dollar, rally in risk assets and positive FPI flows last week. She expects the dollar INR pair to trade in a range of 81.75 to 82.25 next week. She adds that the dollar trend remains in focus post a hawkish FOMC and ahead of the ECB policy decision where a 25 basis points hike is expected.
On bonds, Parul Mittal Sinha, Standard Chartered Bank says bond yields continue to trade range-bound despite rise in global rates. Soft CPI print in line with expectations and the MPC outcome and good investor demand provided support. She expects Indian benchmark 10-year to trade between 6.9 to 7.05% range next week on higher global yields post a hawkish FOMC, which paused as expected, yet left room for 2 more hikes in 2023.
All right, well, that's on the market outlook. We also have lots of specific stocks to track today, and we'll get to that in just a bit in our special segment. Today, we're looking at Axis Bank, SJVN, Swandana, Spurti, M&M, KRBL, HCL Tech, and V-Mart. Those are on the back of positive news flow. Then we also have DCW, KFin Technologies, as well as Avas Financiers. They have some negative news flow around them. We'll tell you what it is in just a bit.
Well, Ed Yardeni is joining us now, President at Yardeni Research. Ed, good to have you with us here. Thanks for waiting. Quick thoughts, Ed. What did you make of the policy and what are the implications for, equity markets around the world?
Right. Well, as you said, nobody was really surprised that they decided to skip raising the interest rates at this meeting. But the big surprise was that they indicated that they will be hiking interest rates some more. I thought that, I wasn't really that surprised. I thought that they would take a hawkish position on the future while taking a relatively dovish position for now. I'm not convinced that they're going to be doing 2 more rate hikes. I think between now and the next meeting in late July, a lot can happen. And I think we're going to continue to see moderation in the inflation rate, moderation in the labor market. So I don't really know that more rate hiking is actually necessary.
Okay, more rate hiking may not be necessary, but that's the indication that the Fed has given. What does this mean for
Yes.
risky assets like equities? Ed, how do you see equities shape up in the latter half of the year, given that on one hand there could be rate hikes, and on the other hand there is still all that talk about the impending recession? What's your view now?
Yeah. Well, the market's done quite well since October 12th. Then there was some concern with the banking crisis back in early March that the market rally narrowed to basically the mega cap 8 stocks, and everything else was kind of languishing. But in the past few days, so far in June actually, we've seen the market broaden out. I think it had a lot to do with the employment report that showed that just another piece of evidence that there is a recession out there. So I think if the economy continues to show its resilience, its ability to grow in the face of this tremendous increase in interest rates, I think investors will embrace that, and I think you'll see the stock market continuing to move higher. I have 4,600 on the S&P 500 by the end of the year. I hope it rests, and I hope it broadens out, and I think both of those are likely.
Mr. Yardini, good morning. So if the Fed does continue to deliver more rate hikes, as Jay Powell indicated yesterday, while the market incrementally might sort of take that as a sign of a positive economy, what about the accidents along the way? Not too long ago, we were talking about all the mid-sized U.S. banks. More rate tightening, couldn't that complicate the story a little bit? Will it be really as much a simple straight line as the Dow and the S&P is simply heading higher?
Well, I think they just wanted to get verbally the perception that they haven't given up on the inflation fight, that they're not satisfied yet. Powell said a few times, Fed Chair Powell said a few times that the core inflation rate's been sticky. He didn't really mention the fact that a lot of that is because of rent inflation. And we know that rent inflation is going to be coming down. So I think, again, I don't think they're going to go for that two more rate hikes. I'm not even sure they'll go for one more rate hike. And I think that one of the reasons is the one you mentioned, and that is we've came very close to a severe banking crisis. We don't want to push that again too hard. And let's not forget that the banking crisis probably means that credit conditions have been tightened somewhat.
Before we let you go, one final word on how you're approaching emerging markets like India, because the situation here has improved quite a bit on the macro front, whether it's inflation cooling off, growth picking up, earnings have picked up now. So a lot of tailwinds for the Indian market. Do you think India could, rise to the top of the pecking order for the second half of the calendar year?
We've talked about this, several times as I've appeared on your program. And I've consistently been bullish on India, mostly because of the entrepreneurial spirit, the capitalism that exists in India, but also because on a global basis, when you're looking for big markets to invest in, India stands out. As I've previously indicated, I'm not a big fan of China, mostly because of its autocratic government regime where the rules for business can be changed willy-nilly. And as we can see, the Chinese government is actually struggling to get their economy to grow a little faster. And that's partly because they've created this big property bubble that's continuing to lose air.
There are political problems as well in terms of geopolitical, rather not internal political, but between the US and China. So people voting with their feet, as we've seen in some instances recently. Ed, good to speak with you. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. Thank you. We'll take a quick commercial break here. Our list of top stocks to watch with our research team coming up in just a bit.
Welcome back to Bazaar Morning Call. Well, this morning the SGX Nifty is quiet, but we've had a really strong run in the last many days and we are virtually at all-time highs. Our research team is now standing by to help you prep for the day, so let's get straight to it. Axis Bank is the first stock on our radar and Nimesh is here with why you should be looking at that. Nimesh, good morning.
Morning, sir. So expect a large block in Axis Bank today. 0.7% of equity is going to change hands. Bain Capital is a seller. The book was launched last evening. The price indicate suggests up to 1.4% discount, but my sense is the block may happen in the block window, hence may not see a big negative reaction. Now, Bain Capital owns 1.3%, out of which they are selling 0.7%. The remaining stake is lock-up for the next 90 days, so they cannot sell further. I guess, the overall feedback is the demand is strong and most likely it will happen in the block window, so no disruption in the stock price, so to speak. But the fact is, Bain Capital is gradually exiting Axis Bank. They'll be left with just 0.6% after today's block.
Okay, got that. Thanks, Nimesh. We'll watch out for Axis for sure. Vivek joins in. Vivek, morning. You're looking at a couple of stocks as well, SJVN and Spandana Spurti?
Absolutely. Good morning. So SJVN, the stock is in focus. The company has gone ahead and signed a memorandum of understanding with Maharashtra Genco, which is basically the Maharashtra State Power Generation Company. Now, this particular MOU is for the development of close to 5,000 megawatt of renewable energy projects in Maharashtra. Now, also Mahagenco and the company will go ahead and jointly bid to go and renew as well as do some amount of maintenance work as far as some of the older hydropower projects are concerned. Now, this actually, according to SJVN, will go ahead and help achieve that vision that they've set as far as up till 2030 is concerned. So the company aims to go ahead and complete 5,000 megawatts by 2023-24, 25,000 megawatts by 2030, and 50,000 megawatt capacity by 2040. Also keep an eye out for Spandana Spurti. Newspaper reports indicate, and we have not independently verified these reports. However, what reports are indicating is that private equity investor Kedara Capital, that owns almost 48.34% stake in the company, has initiated discussions with Yes Bank in order to explore a likely M&A deal in order to exit their complete stake in the company. The proposed deal with Yes Bank is likely to be via the share swap method, and this is something that will keep Spandana Spurti active in the session today.
We had Spandana Spurti management day before yesterday with us on Bazaar, and we actually asked them this exact question. Of course, they said that they have no indication that this is going to happen. They said, well, existing investors are on board, and but they also kind of said, well, this is external shareholders, so we'll have to check with them. So just FYI, 733, 734 on Spandana as yesterday's close. Well, Surabhi is now joining in with more stocks with news flow. Surabhi, morning.
So morning. So first on my radar is M&M. In line with the company's global expansion strategy, the company has launched the XUV 700 in the Australian market. Next is KRBL. The company has commenced commercial production in its Gujarat plant. HCL Tech, the company expands its strategic partnership with Google Cloud to boost innovation and adoption of generative AI. Next is DCW. The company is facing some mechanical breakdown in its soda ash plant, and it estimates that the soda ash production will be lower by 6 KMT for Q1 of FY24. And lastly, KFin Technologies. The company withdraws its application to be a depository participant with NSDL. Now, they had filed this application in October of 2022, and now they have withdrawn it. So some negative impact on KFin for them.
All right, thanks a lot for that. Well, let's go across to Vivek now. He's tracking V-Mart and Aavas Financiers. Vivek, why is that?
Well, two large block deals in both of these companies in yesterday's trading session. V-Mart, T. Rowe Price International Discovery Fund yesterday exited 1.9% stake via the block deal route. So it's likely a clean out trade. At the end of the March quarter, they held around 2.07% stake. Interestingly, the buyers, Amansa Holdings, buying almost 3.4 lakh shares in the company, and the stock was a sharp mover in yesterday's trading session. Also, Aavas Financials, going with the red on this particular name. Small Cap World Fund yesterday sold close to 1.6% stake in the company. Interestingly, at the end of the March quarter, they held almost 7.99% stake. So going with the red on this particular name on the back of the overhang that you're seeing from the Small Cap World Fund holding.
All right, Vivek, thanks a lot for that. So let's do a quick recap in case you missed out on any of these stocks with positive news flow. There's Axis Bank, SJVN, Spandana Spurti, M&M, KRBL, HCL Tech and V-Mart Retail, while stocks with negative news flow, there's DCW, KFin Technologies and Aavas Financiers. All right, Manisha Gupta is joining in for a roundup of all the action from the commodity markets overnight, and she is in Gujarat. She's joining us on the phone line. Manisha, first, hope you are safe. What is the situation on ground? And also, what are you tracking in the commodity markets?
Well, Sonia, I'm in Rajkot and the airports have been shut for the last couple of days now, so all flights grounded. So I'm finding a way to come to Mumbai. But yes, it's windy, it's raining, and you can see the cyclone passing by. As far as the commodities go, well, US Fed was the cyclone yesterday, and we've seen that immediate reaction come into many of these commodities. I'll start with crude oil prices because we have seen prices just continue to hold around that $68 a barrel mark. That is because the US inventories have seen a gain of nearly 8 million barrels. Markets were anticipating just about 500,000 barrels of an increase. So that is what is weighing on here. And then the fact that the rates will stay higher for longer also seems to be dampening the sentiment here. That clearly has led to gold and silver prices now trading at a 2-month lows. But the China new home prices trading for the first time, the highest in 13 months, is what really seems to be supporting the metal prices right now. I mean, we've been telling that metal prices are near bottom. So copper prices gained up by a percentage point, and zinc and nickel were up 3.5% overnight and continue to trade quite positive in Asia right now.
Okay, well, Manisha, thanks very much for that. You be safe and, see you soon in Mumbai. Take a quick commercial break here. Deepan Mehta, Director at Elixir Equities, will be joining in for some stock talk. We'll also connect with Nikhil Kamath, co-founder at Zerodha and True Beacon, to discuss, what mutual funds may or may not do now without any exemption, any special exemption with regards to maximum holdings post the HDFC Bank HDFC merger. There is also that SEBI circular from day before yesterday, which has made it compulsory for execution-only platforms to get registered with SEBI for being able to offer buying, selling services of mutual funds. So two topics. Nikhil Kamath on that in just a bit.
Welcome back to Bazaar Morning Call. Well, for now, let's just get a couple of stock ideas going. Deepan Mehta, Director at Elixir Equities, is joining us now to talk about the big moves that we've seen lately in many spaces, actually. Deepan, hi, good morning. The space I wanted to talk to you about was metals, because we've seen a big comeback here. Now, I know this is not one of your favorite, sectors to invest in, but from a trading angle, do you think that there is more to go here? I mean, JSW Steel, for example, is already up 10% this month.
Good morning, Sonia, and thank you for having me on your show. See, that's the characteristic of all these commodity stocks, that they have these very sharp trading rallies based on news flow as regards price or some global development, could be China, could be US, anything, and then the sentiment kind of changes, but the sentiment also changes on the toss of a coin as well. So it's very difficult to keep track of these metal companies, commodity companies, as to where they will be 6 months, 1 year, 2 years, 5 years down the line. And that's the reason, rather than wasting your energies on something which is so uncertain and so volatile, you focus on the more certain stocks where there's secular growth momentum, where the business models are understood better, where the managements have better control over their end product prices, their input prices, rather than the commodity stocks, which are just swayed by external factors. So keeping that in mind, we generally have had a negative view on metals, but sure, there could be trading rallies. And if you have that mindset where you want to trade the rallies, then you should understand these businesses better and the stock price movements better, and then perhaps you can make some money on it. But I haven't been successful on that count, so I generally always avoid them.
Deepan, hi, good morning. So many stocks, right? I was somebody jokingly told me, and this is a seasoned investor, he said, there are so many ideas now that I'm out of money. Not me, but the person I was speaking with. He said, I'm stopping any new meeting.
Even I'm out of
what
money.
do you do with all these ideas? You're fully invested.
Yeah. See, I'll tell you one thing, Prashant. Really, it just builds my conviction in stocks. We've been patiently waiting for so many quarters, waiting for the markets to rally. And mind you, small mid-cap stocks haven't done as well, over the last 4 or 5 years or so. I think right from ILFS crisis, I would say that at that point of time, the small mid-cap stocks have generally underperformed. The market rally has been very narrow, with either Reliance doing well or Adani stock coming into focus. Sometimes it's L&T, M&M, Maruti. But the mid-cap stocks, small-cap stocks have just been in wilderness. And now they are coming back strongly. The key characteristic here is that even small volume, small purchases also can take these stock prices higher. I suspect a lot of money is coming into the portfolio management schemes as well. And these are the fund managers or portfolio managers who are very focused on mid-cap stocks. And they are buying the same stocks to kind of, keep the number of stocks in their overall portfolio the same. At the same time, I think a lot of HNI activity also has increased, and they are focused on mid-cap stocks. And generally, I think the numbers for mid-cap stocks have been very decent. These companies, these businesses tend to thrive when inflation is low, when prices are coming off and demand is generally strong. So you have a culmination of many positive factors, right from liquidity flowing into them to overall better business prospects, which is driving these stock prices higher. And valuations, I think, historical basis are still at reasonable levels.
And we have absolutely point taken. We had Prashant Jain yesterday with us, on closing bell, and we'll play out some snippets of that conversation. He told us that every month, he's getting about 300, 400 crores in fresh inflows. So money is flowing in through the SIP route, and I think, of course, to some of these investors as well, other structures as well. Let's talk about the brokerages and what you need to know in terms of what the sell side has written this morning. What are the stocks in focus? Sonal is here with those cues. Sonal, morning.
Good morning, Prashant. Well, let me start with Citi's Morgan Stanley's note on Indigo. They have an overweight rating with a target price of 3,126 rupees per share. All key earnings drivers are moving favorably for Indigo, and their market share gains could continue. Near-term profit per seat could hit a cyclical high, and that's why Indigo should be on our radar as well. Citi has written on JSPL. They have a buy rating with the target price of 650 rupees per share. They speak about the recent announcement by the company where they've announced diminution of its investment in JSPML of up to 7,780 crore rupees. They say the company had already recorded an impairment against this investment in Q3 FY23, so this is not a new update here. However, the investment has now been written down, resulting in tax benefits, so they will see some tax benefit here, but this was something which was already known and the company had already accounted for. Citi has written on HCL Tech. They have a neutral rating here. They speak about the company seeing 4 big potential service opportunities in generative AI. That has been the big word now. Company has partnered with AI ecosystem and working on AI solutions with over 150 user cases here. Motilal Oswal has written on Sun Pharma. They have a buy rating with target price of 1,160 rupees per share. They say the specialty brands are seeing some promising growth, and specialty portfolio is building robust global franchise as well, and this is an outperforming segment for them. US generic sales are stable despite multiple headwinds in the global markets, and that's why they're bullish on the stock.
All right, thanks a lot, Sonal, for that. In fact, Dipan Mehta, who tracks this entire IT space very closely, I wanted his view
on, the comment that Sonal was making on the brokerage report on HCL Tech, where they are investing heavily in this generative AI space, and there's a lot of opportunity here. This is the new buzzword, right, Dipan? Anyone and everyone is investing, but it's kind of like, a space where once you get in, you realize what the pitfalls are. It's not easy to make money here, especially in AI tools. Tell me a little bit about the companies, the listed entities, where you believe that there is scope in this space.
Sonia, I suspect that even this AI opportunity and the related kind of projects which come through, the mid-cap, small mid-cap companies will benefit more. And, we had this Happiest Mind Management on your show the other day. I think it was exactly last Thursday. And the question I asked them is that why are small mid-cap stocks doing better than large-cap stocks in terms of growth rates and therefore valuation? And he made a very pertinent point that a lot of these projects are small-sized projects, and they are projects where mid-cap companies have an edge in terms of technology, in terms of talent, in terms of the agility with which they can execute these projects. And these small-sized projects, $20, $30 million projects, can make a huge difference in the growth rate for a mid-sized company, but it won't even move the needle for a HCL Tech, Infosys, or TCS. So the real problem with within the IT space is the large-cap stocks are so huge, and the revenue base is so high that smaller projects, even if they are, in this particular space, will not make much of a difference. They typically need a kind of a nice economic environment, positive growth rates, sharp increase in tech spending, and a lot of these type of $300 million transformative deals for them to sustain those kind of growth rates. Therefore, my view on large cap stocks is negative. But in mid-cap stocks, on and off, you will keep finding winners. And look at the number of mid-cap stocks hitting new highs. I mean, can you believe that US is in this kind of a shape? Economically, Europe is in such bad shape. But you have at least half a dozen mid-cap stocks which are at or around their all-time highs, which just shows that, the maturity of these businesses, and they've clearly found their niche and space. So I want to focus on mid-sized companies. You can look at the names separately.
Okay, got that. Deepan, stay on. We'll have some more questions for you in just a bit. But let's also look at an interesting regulatory development when it comes to mutual funds. Now, SEBI, just a few days back, came out with a 13-page paper, basically a directive. It's not a consultation paper. It is the rule that will come into force from the 1st of September. And this is to streamline the way direct plans of mutual funds are being sold. So till now in the market, there's been a fair amount of confusion. An entity can sell a regular plan and a direct plan. Now and then also there's no clarity between whether is this entity an advisor, is this an advisory role, where also direct plans are being sold, or how does this really go about? So what this paper now is really talking about is creating a framework for what is being called the execution-only platform. So as the name suggests, they will only streamline platforms where there is execution taking place, which by effect means only direct plans of mutual funds. So number one, this has nothing to do with regular plans. This is all about direct plans. Now, what SEBI is saying is that it's proposing to create two separate categories. There is EOP1 and EOP2, execution-only platform 1. First category will be entities that will align themselves directly with AMCs. So they will act like agents of AMCs. And then the paper goes into details of how commissions will be shared and how much AMCs will have to pay, etc., etc. The second category, category 2, is EOP2. Now, this is a set of entities which will go through the stockbroking route, which is where our understanding is that a lot of the stockbroking platforms, for instance, Zerodha, also allows you to buy mutual funds. So do a couple of others. So the sense in the market is that most of these large entities, which are already providing both stockbroking and mutual fund services, will probably opt for the EOP2 route. What else changes? Well, let's put that question to Nikhil Kamath, co-founder Zerodha and True Beacon. Nikhil, thank you very much for joining us. Just trying to simplify the basic construct and the setup for our viewers. Let's start with this. Do you see yourself going in for the EOP2 category? And what more changes? Because I believe that now these platforms cannot offer regular plans at all. There will be, of course, the KYC guidelines, some of the other guidelines that will be followed. What happens to the fees that's being earned by platforms like Zerodha, if at all, from the sale of mutual funds?
Hi, good morning. So we were never really charging any fees for this from a transaction perspective, but I think it's too early for us to comment. We're still trying to figure out how we would go about in implementing this, but I think it'll take us some more time before we figure it out.
Nikhil, hi, good morning, and thanks for joining us. Will there be any change in the business or the operational model for you, just to try and understand how things may shape up over the next 6 to 12 months because of these guidelines?
No, Sonia, I don't think so. And I think further clarity is required on this subject, and this is still too fresh. So you'll have to give us a little bit of time before we figure it out and implement it.
But Nikhil, just to understand, till now on the platform, were you offering only direct plans or also regular plans?
It was only direct.
Okay, so then in that sense, you don't have to change much because the regulation now says that only direct can be offered.
Yeah, we've only ever offered direct plans. So we've never done the distributor model.
I think the reason Surbhi is asking is because, making money in direct plans is not really that easy, right? So, and now that SEBI is giving you an opportunity to offer regular plans as well, would you have any intention to perhaps go ahead with it at some point?
So, too early to say, Sonia, but I don't think so.
Okay. So, Nikhil, the sense seems to be that, maybe not at Zerodha, but elsewhere, there was a practice also at the end of banks and maybe some other stockbrokers where there was a mix of regular and direct happening. There was also a mix of quasi-advisory, but also direct. And therefore, this had to be streamlined. So in light of that, not for Zerodha per se, but in light of what this will mean for the overall industry, what's your sense? Is it a step in the right direction?
I think it's a step in the right direction. Surbhi, personally, I believe direct plans should have been the only thing that were ever sold. I think it is fairly illogical for somebody who's just selling a product to charge the amount that some people had charged historically. I think the distributor model is quite skewed when it comes to wealth management products largely. I don't think distributors should charge or warrant the amount of commission that they do. And I think this getting streamlined will only benefit the end consumer, and I think it's a good thing.
So doesn't it make sense for you to go in for EOP too? Because you already have a broking setup, right? So, I mean, going forward, I know you haven't taken a decision just yet, but does it make sense for you to go in for the EOP2 model?
Honestly, Sonia, I don't know yet. So I think you'll have to give some time to us.
All right. We'll leave it there, Nikhil. By the way, you're giving us a run for our money with all those interviews, Nikhil. Congratulations. Sorry?
Yeah, so the podcast, you mean?
Yeah, the podcast. I mean, it's wonderful. I've
I'm only
heard
doing one a month. Yeah, I'm only doing one a month. And the intent was very much, create some not-for-profit content which is truly focused around educating people. We're flipping it around and making it like a charity project. So it should be interesting.
It is interesting. And congratulations. Wonderful work. Thanks very much, Nikhil. Appreciate you joining us with that. So that is, those are quick comments coming in from what SEBI is saying with regards to how mutual funds can be sold on some of these platforms. Deepan is still with us. Let's just get back to markets. And I think Deepan is with us, but we will have to take a break and then we come back to him for more. So let's do that. Stay tuned. More stock-specific discussion coming up. Anuj comes up with his trade setup in a bit from now. And of course, our technical analysts with their specific calls for the day lined up as well. Stay tuned. Okay, well, we'll take a look at what the SGX is doing. Welcome back. And it's not indicating very much. 30 points lower. 18,806 is where we're at. Anuj is here in the studios to tell us what he's making of things. Anuj, morning.
Morning, Prashant. Well, you know what, today I think the bigger factor is what's happening with China, because that I think clearly second day of rate cut by China, clear signs that it's going all out to revive economy. And the big question is, will some funds now start to chase Chinese markets? And can we go through a period where, some funds shift from India to China because there's a valuation comfort in Chinese market? Of course, also keep an eye on the commodity prices. That's something to keep an eye on because of the China factor. But Fed's hawkish pause, I think, is something which was on expected lines. Now, on the market, I think maybe our focus now shifts to monsoon from here on. That becomes the bigger cue. My sense is you hit all-time high in next few days. It's a matter of when and not if. The only problem is the bank nifty has been struggling a bit, all due to technical factors. HDFC Bank and HDFC merger, I think the record date should be out very soon, within the next 1 month or so. And today's Axis Bank block deal as well. So there are a couple of factors which are impacting bank nifty. But broader market has been doing well, and that I think could continue to do well. Focus on Nifty Junior, which is still about 2,000 points off the highs, while the mid caps and small caps have hit all-time high. The other factor is Nifty IT. It's been consolidating at the 200-day moving average. That's a bit of a make or break zone for that index. But second day running, focus could be on metal stocks because of the China factor. On the Nifty, today's options expiry, so you respect that range, which is 18,670 to 18,780. But I won't comment too much on Bank Nifty today because the conviction there is missing. It's been struggling for the last couple of days, so rather focus on the Nifty today.
Anuj, that Hindi couplet, वो जरा शेर है कपलेट है. Remember that we were discussing FOMC रात को जागे वो बस
Share or shari happening on the FOMC. Wow, I'd love to hear this.
No, I'll give you the context. We were discussing how it is futile to stay up for these events.
Exactly, I don't.
And you just come back in the morning and
Exactly.
look at
It's a new world.
So let's hear it from Anuj.
जिन्हें फिक्र है कल की वो रोते हैं रात भर, जीते हैं जो आज में वो सोते हैं रात भर.
So the point is, go to sleep, enjoy your sleep, and then come back in the morning and figure it out.
Absolutely.
Right?
Thanks very much, Anuj, for that. Well, that is the trade setup with Anuj as always. Deepan Mehta is with us. Deepan, just a quick word on names like V-Mart. We had a very large move yesterday, 7-8%. And in the blocks data, we learned that Amansa has picked up shares. T-Row price sold and Amansa picked up. Amansa is already a 7% shareholder in V-Mart. I mean, it's a share which has not done anything at all. I mean, it's languishing at lows. What are your thoughts? I mean, it's not in the favored list at all. The consumer sector is hurting. It caters to the tier 2, tier 3 cities. But does it make sense at lows?
Yeah, Prashant, I think that it's only a matter of time before the demand comes back in the tier 2, tier 3, which are very much dependent on monsoon and agriculture. And already on the FMCG side, we have seen a revival in the rural demand. And if that is to translate into demand for retail companies like V-Mart, then it's just a matter of time before V-Mart also starts to report better growth numbers. And, this is a very interesting company. A very aggressive management. They know exactly where their position is. They have very strong competitive strengths also. And this entire trend towards premiumization, consumers going towards brands and moving up the value chain, I think all of these trends certainly benefit V-Mart. Very strong balance sheet, and they can keep on expanding further and further into their territories. And the acquisition of Unlimited also opens up new opportunities, and that also the synergy has not been realized fully. So generally positive on V-Mart, a disclosure that we and our clients are invested in it. But it's more of a longer term horizon over here. But I think 1 or 2 quarters down the line, you could have a positive upside when it comes to the financials.
All right. Well, Deepan, just stay on. We'll come back to you in a bit. Mitesh Thakkar and Sudarshan Sukhani are also joining in to give us a couple of cues for the day. Sudarshan, let me start with you. This is a market that is virtually at all-time highs. What do you do at a time like this? Not just for today, but as a positional trade. Do you continue to go long, keep your long position open? And while you're at it, what are the individual stocks to look at today?
Well, good morning. Well, the market is in a very strong uptrend. In an uptrend, we try to buy wherever possible. For the day and maybe for the next few days, the two levels where I would buy are, if there is a dip towards 18,600, that could be a buying opportunity. Or on the other hand, if the market breaks out above 18,800, that's the resistance zone. So then that breakout becomes a buy. But the key point to understand is that this is a buying market. It's not something where you try to call a top. That's not something we do. But on the other hand, the Bank Nifty is doing nothing. It's in a trading range. It's not even in an attractive trading range. So the focus should be entirely on the Nifty, and the Bank Nifty should be left alone. For the Nifty, I've given you the ideas. Buy on a dip, buy on a breakout, but be long even now. Now for the stocks. The stocks are a mixed bag today because the stocks are specific for the day, and today could be a choppy day. Starting with Tata Motors, where there is a buying opportunity with a stop under 555. Gujarat Gas has already broken down. It's made some kind of a bearish flag. It's probably looking lower levels. There's an intraday short with a stop above 490. Similarly, another intraday short comes in Bandhan Bank. It had a big down day, and that breaks the trading range, and it's probably heading for a deeper correction. That's an intraday short with a stop above 262. Finally, Godrej Consumer Products is a buying opportunity. The buying should primarily be done positionally, because the big money comes in gaps. So Godrej Consumer Products is a buy with an initial stop under, I think I missed the stop. Just buy it. Let's keep it there.
Okay, so Darshan got that. By the way, the Axis block deal has happened. Nimesh alerted us about this. It's 2.2 crores shares moving around. Of course, we'll have to wait till the end of day to see the exact identity of the buyer and seller. But the anticipation was, as Nimesh was pointing out, that this could be Bain looking to sell part of its stake in Axis Bank. Okay, that's a stock in focus. Let's go across to Mitesh now. Mitesh, good morning. Are you trading either the Nifty or the Bank Nifty? And beyond the indices, what stocks are you looking at today?
Good morning. We already have a long on the Nifty. Yesterday, when it, the day before yesterday, when it started getting past 18,650, that long we've suggested trading the stop loss to about 18,685. And I think what point Sudarshan was making was very important. The Bank Nifty isn't really, participating. And if the Bank Nifty starts breaking below levels of 43,800, 850, then I think you might want to have a short in the Bank Nifty as well. My overall idea is that if the Bank Nifty does not participate, then getting past 18,800, which is the highest ever closing, I think 812 actually, will be very difficult for the Nifty. And therefore, I think, the markets might go into some kind of a contraction again. So we'll keep a close watch on the banking index. And trading wise, I think we still have a bit more long bias on stock specific basis. But broadly, I think till the Bank Nifty participates, we'll not take an aggressive long. And coming to my stock calls, I have a buy on Grasim. It's a conditional buy if it starts getting past yesterday's high of 1785. Buy with a stop at 1764 for targets of 1835. MGL is a buy with a stop at 1034, targets of 1075. Oberoi Realty is a buy with a stop at 987 for targets of 1070. And one sell call, ICICI Bank, if the stock breaks 933, trading just 3-4 points above that, sell with a stop at 945 for targets of 906.
All right, Mitesh and Sudarshan, thank you very much. I have a few more stock setups I want to discuss with you guys. So see you soon. The winners have been gaining gains, beget gains, as they say. But even some of the underperformers like V-Mart, look at something like a Galaxy Surfactants. These are names which are starting to come up. I mean, the market is hungry for ideas. There is not rotation, but generally it's a rising tide lifting most boats, not all yet.
And as you said, that you don't have enough money to buy, right? The stocks in the market.
Not me. Somebody I was talking to. It's true story.
It's a great problem to have, actually.
No, because you're fully invested, right? I mean, and then you've got to get the next paycheck or whatever line of business you're in, but you need...
but you're hungry to sort of participate in that, the FOMO feeling.
Oh, absolutely. Well, Rajesh Palvia is with us of Axis Securities. Rajesh, good to have you with us here. Good morning. How are things looking from a F&O standpoint, and what kind of trades would you want viewers to take this morning?
Good morning, Prashant. So overall setup is on the bullish side only. We have witnessed Nifty has continued, so it's a long built-up setup in the previous session also. But yes, Bank Nifty has witnessed some sort of long unwinding. So Bank Nifty may remain under some pressure, but overall market breadth and the setup for Nifty is on the bullish side. So our strategy is to remain on the long side. Yes, we do believe that, in this rally, we can see a new all-time high for the Nifty also. As in the previous session, we have seen again 18,700 has attracted put writers for current series as well as for the next weekly series, which clearly suggests that base is shifting higher. So the addition of put is clearly indicating that yes, there might be another round of rally we can expect in the Nifty also in today's session. So to play this upward momentum, we are initiating here to again buy a call option of 18,800 strike of 22nd of June next weekly expiry, which was closed at around 96 rupees. We are keeping a stop loss of 60 rupees and upside target we are projecting around 140 to 150, as we are expecting that 18,650, 700 is likely to act as a good support area for the Nifty for any kind of minor dip in the market. So buy on dip should be your strategy. On the stocks front, we believe that FMCG pack can do well, and from that space, Hindi Unilever has shown a good buying action especially in last half an hour of trade. And looking at the data setup, we believe that HUL can continue furthermore upside. And upside target we are projecting around 2740, 2760. One can keep a stop loss of 2645 to go long in HUL. Another stock is from real estate space. That space is continuously showing good traction in terms of buying. And most of the stocks are showing good buying interest. So we are recommending here to buy Godrej Property. Stock has witnessed a long built-up setup in the previous session. And looking at the technical as well as derivative data, we expect a target of 1560, 1570. Keep a stop loss of 1470 to buy Godrej Property. Another stock is Petronet LNG. Stock has shown good buying interest, and now stock is trading about to its 50 to 100 day moving average. Kind of addition and the breakout of consolidation range is clearly indicating that this stock can scale up further higher towards 245 to 250. Petronet is buy with stop loss of 226.
All right, Rajesh, thanks very much for those views and those specific trades as well. We'll take a quick commercial break here. There's a minute to go for the pre-open. We are back with that. Harshit Kapadia of Elara Capital will also join in to put the focus on defense space and the stocks that you should focus on after the rally that we've had this year. Stay tuned.
Welcome back. It's 9 a.m. and you're with us on the CNBC-TV18 Motilal Oswal studios. We're coming to you live. By the way, the first pre-open rates have just started coming in very early on, but the first ticks are green. That's what we are getting. Want to see what the tick on Axis is like, actually. Slightly lower, mildly lower, but other than that, some of the other early bank names are moving on the upside. HDFC Bank, for instance. Suggestion is right now that we could get some positive sort of cues at the start, but let's wait for it to settle. HDFC, L&T, these are some of the names on the downside. Nifty now turns negative, 6 points lower. So that's pre-open for you. But let's straight away go to our Momentumizer segment. Manglam is joining in with today's stock. Which one is it, Manglam?
Well, there is a lot of momentum in the realty pack, so I'm looking at one of the real estate stocks as well. It's Arvind Smart Spaces. The stock is near all-time high, just about 2% away from fresh all-time high. Yesterday, the stock was up around 5%. In fact, this month, it's up around 12%. And in the last 12 months, the stock has been on a tear, up almost 130-odd%. The important thing about yesterday's move was it came on the back of huge volumes. Yesterday's volumes on the stock were 2.3 lakh shares traded. In fact, this compares to the June average of 1.3 lakh. And the 3-month average was just about 80,000 shares. So nearly 4 times the average volume at record highs for that stock. And that coincides with the realty index itself moving to a fresh record high too. What does the company do? Well, it is, it was a demerged arm of the Arvind Group, and as a result of which it has strong presence in Ahmedabad and increasing its presence in the Bengaluru residential market as well. The company, when it joined us last, has said that they have 22 million square feet of launch pipeline going ahead, and they target 15% share in the markets that they operate in. So those are a couple of factors that we're watching out for. Strong momentum, the stock near record high.
Okay, so Arvind Smart Spaces definitely in focus. Thanks for that, Manglam. Deepan, hi, morning. Didn't get a chance to, check one specific stock with you actually, and that is Persistent Systems, because suddenly there's a lot of negative brokerage commentary around it. Brokerages saying that this one is most exposed to discretionary spending, And given what we've seen from EPAM earlier, maybe there's a case to take some money off the table. What do you think?
See, I think these minor negative news flows will keep on coming and going, and they shouldn't kind of shake out the long-term investor, because clearly Persistent Systems have been one of the best performing stocks. One of the best performing stocks. So from that point of view, I still remain invested in it. And as I said, I think aggressive management, smaller project sizes benefiting them. They have certain very specific skill sets which they offer to their clients, and they've clearly established their reputation and space within the IT industry. So I remain very positive on Persistent Systems. Sure, there could be a period of underperformance, compression of P multiples, maybe even one or two soft quarters. But the basic business model and the kind of value they bring to their customers, that remains exceptionally strong. So we would like to remain invested in the stock.
Okay, so you're saying you remain invested in the stock, but yeah, actually just wanted to put Ambit's view on board, because this morning Ambit has initiated a coverage with a sell, and I guess that was Surbhi's reason to ask you, because the last 2 days, two brokerages have come out with cautious commentary on Persistent. Ambit has a target price of 4140, and they talk about how growth will slow down in FY24. They're saying that the company has an 80% exposure to the slowdown-prone BFSI and high-tech segment, and short-cycle deals are seeing a pullback now. Also, valuations are pretty expensive at the moment. The stock is trading at 30 times 1 year forward, which is a 51% premium to its tier 1 tech stock. So I take your point on board, Dipan, that of course the long term is favorable for Persistent Systems, but in the shorter term, there are some concerns that brokerages are raising. All right, we'll come back to you in a bit. I want your thoughts on defense stocks as well, because that's the other big buzzing space. The defense stocks have, seen a big up move as the government's push for defense indigenization continues. Harshit Kapadia, the analyst at Elara Capital, joins us now to talk more about that. He has written a very in-depth report on how, the defense sector is growing and how they continue to be optimistic here. Harshit, thanks for joining in. You talk about an 11 trillion rupee opportunity in terms of orders for the next 8 years in the defense sector. Tell us a little bit about that. Who could be the biggest beneficiaries of this, and which are the stocks where there's both valuation and growth headroom now?
Morning. So on the 11 trillion opportunity, we see Air Force as biggest opportunity for them. Close to around 4.5 lakh crore is what the size of opportunity exists for the Air Force related segment. So you can see helicopters and aircraft being the major product there. And one company which will be the biggest beneficiary for this would be Hindustan Aeronautics. Followed by this, we have close to around 2 lakh crores in Navy. In Indian Army should be looking at an order, giving out orders of close to around 1.5 lakh crores and another lakh crore for the missile opportunities, what we see in this space.
Harshit, just want to your topic is Hindustan Aeronautics, where you have a buy. I think you also like BEL, Bharat Electronics, as well as Bharat Dynamics. I don't see too many of the shipyards or the guys who are making these naval vessels, because we're hearing so many details on these big orders, right? Whether it's Mazgaon Dock, Cochin Shipyard as well. So not an area of interest for you?
No, it is an interest area. We are also pushing GRSC, given the executions is going to be great. As far as inflow is concerned, so one large order is expected coming in next year. That is for next generation Corvette, which is of 36,000 crores. Right now, recently, there was an MOU signed between the German company ThyssenKrupp and MDL for the submarine project. And even L&T is looking to partner it with a competitor. So that could be another opportunity. But it will at least take 3 years' time from now on to get these things rolling and coming in terms of order inflows. So long-term opportunity exists extremely for even shipbuilding companies.
Just 2 points, Harshit, and we'll get to more stocks in just a bit. Are you seeing more, directionally, are you seeing technology transfers happening? Or do you think that is still, when we talk about this tie-up with ThyssenKrupp, for example, or with Boeing, etc., are you seeing the directionally there is more technology transfer? Because that used to be the big issue earlier. Yeah, go on.
Yeah, so absolutely, you pointed exactly right now the momentum on transfer of technology, which has been one of the biggest hindrance for India in absorbing the technology, has been now getting cleared. So a lot of countries like Germany, France, the recent probability of US sharing technology is also going to be now coming forward. Israel has always been a great partner for India, and so has Russia. So we always had been the technology from these, but now we are getting technologies from the West as well, which is also a huge impetus for the sector.
I wanted your thoughts also on some of these companies like MTAR Tech, Dynamatic Technologies, etc. I know you don't have a rating on them, but you do look at the business potential here. These are stocks that have delivered quite a bit in the last couple of years at least, although the recent past has not been too great. But if you can tell me what the upside looks like for some of these names and what's the business potential?
So in terms of business potential, so some of these companies are, suppliers and component manufacturers for some of the large projects which are there in pipeline, the 11 lakh crore opportunity which we spoke about. So within that framework and with government getting stricter on the indigenization policy, and government has still now come up with 4 lists in terms of indigenization for even components and LRUs, line replacement unit. And these are the companies who will be manufacturing those components. So for them, it will be a much bigger transition as we get more things indigenized, more platforms indigenized. Both MTAR as well as Dynamatic, as well as Data Patterns and Astra Microwave are the other companies who could be beneficiary of this entire supply chain.
Got that. So there's this whole chain, and you can play the large players that are finally delivering orders or the component makers. Got that. So let's club it all together, Harshit. Let's recap your top 3 or 4, stock picks, and also give us a sense on valuations. You like HAL. HAL has run 100% in the last 1 year. Some of the others, I was looking at Bharat Dynamics, again, 35-40%. So are valuations still giving you the headroom, or are we now probably, trying to jump onto a bus that's already running away?
No, there is still a comfort on the valuation side as well. Given we are seeing surprise also coming from the exports, which has been an unexplored market for most of these companies. So that could be further given a chance of re-rating for these companies, and hence HAL still remains my top pick, followed by Bharat Electronics and Bharat Dynamics.
All right, Harshit, thanks very much. Good speaking with you, and a good conversation as always. Useful for viewers who are looking at some of these different stocks and how they are doing in the market. What to do now is the question always, isn't it? 5 minutes to go for the market open. Mitesh and Sudarshan are with us with their 9-10 calls. Mitesh, what do you have?
I think I choose buy on Grasim if it starts getting above 1786. Keep a stop at 1764. 1835 is the target.
Okay, that's a buy on Grasim. Sudarshan, what about you?
Tata Motors is a buying opportunity with a stop under 555.
Okay, that's on Tata Motors. Been one of the biggest stocks in the market this year, up almost 50%. Axis Bank, by the way, on that impending block is up almost about 1%. So do keep your eye out on that. Ekta's joining in now. There's an interesting report by JP Morgan on hospitals. So Ekta's going to tell us more about that. Ekta, morning.
Hi, thanks for that. Well, yes, JP Morgan has written on the Indian hospital space. They've initiated coverage. They believe it is ripe to absorb expansion. So they have an overweight on Apollo as well as Fortis, neutral on Max as well as Medanta. Now, according to them, there is secular growth, supply shortages which offer promising growth prospects. Sustained demand, occupancy at near optimal level necessitates expansion, according to them, within the hospital space. Profitability improved and it's likely to sustain for hospitals. They forecast a 19% EBITDA CAGR over FY 23 to 26. So bullish in terms of the prospects of the hospital space by JP Morgan.
All right, Ekta, thanks very much for that. We'll keep an eye. That's another sort of interesting space poised for some secular growth out there. Well, mid-cap, lots of action in mid-caps, right? And so many block deals are happening. We highlighted a few, but there are more. Vivek has got that list. Vivek.
Well, that's right. Yesterday in yesterday's trading session, you saw quite a few large blocks happening in select mid-caps, and there was significant price action as well. So first on our list, Sangam India, yesterday a large move, very interesting, buyer and seller names. So Satpar Khattar sold almost 1.8% stake in the company, and almost absorbing the full stake was Madhuri Madhusudan Kela, buying almost 8.4 lakh shares. The other one on our list, D-Link India, yesterday Ashish Kacholia paid significant stake, slightly over 1%, 3.69 lakh shares. He sold at 227.9 rupees a share. V-Mart Retail, we highlighted it. So T. Rowe Price International Fund, completely exiting their stake. And the buyer yesterday, again, absorbing almost the full block was Amansa Holding, buying 3.37 lakh shares. And lastly, Aavas Financials, this could be an overhang on the stock. Small Cap World Fund paired almost 1.6% of the total 7.99% stake that they held in the company at the end of the March quarter.
All right. Thanks very much, Vivek, for that. Put up Z, which is now, by the way, entered the F&O ban. Mitesh is with us. It'll be interesting to highlight. It's been such a, from a trading perspective, disappointment, right? I mean, it gives those moves and then they promptly come off as well. And that's been the experience all the way this year from January or February. It's been in that range, about 210 on the upside, and on the downside goes up to about 180 or so. Any thoughts, Mitesh, here? Z?
Prashant, I think you highlighted a very important point that it's been in downtrend since actually not January 23 but December 22, and I think that is why I think because the bigger trend is on the downside, rallies get sold in. I think the stock needs to have a big move beyond 210-15 zones to signal a trend reversal on the larger chart, and then only I think it could be a good short-term trading or swing trading bet.
I just want to point out Spandana Spurti as we hit the opening, Sonia. 2% higher. There's a lot of M&A buzz around this that, the existing PE investors are looking to sell out and they could be in talks with the Yes Bank. Newspapers are reporting that, but that's one more on the board to watch out for today.
We actually had that commentary with the management as well, right? Where we kind of pestered them to tell us whether any sale is happening. But they said, no, nothing that we know of. And of course, they won't tell us, but this buzz is still in the market. The stock is up and about. By the way, we have about 30 seconds left for the markets to open. Looks like we're going to be holding on to the levels that, we closed in yesterday, 18,770. Remember, there is lots. The Nifty is now, less than 150 points away from all-time high. So that sort of benchmark is something that we're gunning for. And lots of individual stocks in focus. Axis Bank, after that Bain Capital deal took place, will be also in focus this morning. Plenty of other stocks that we're looking at. Well, here you go. Here's the first tick on the index, absolutely flat as we begin opening today. Not doing much at all. The Nifty is at 18,750. You have the mid-caps that are very, very quiet as well, up just about 22 odd points. Big movers, Axis Bank, not a big mover really, just the top gainer at the moment, up about 0.2%, I think. Then you have a couple of other names. Divi's Labs is up 0.6%. Bajaj Auto has been one of the strongest stocks this year, up 30% for the year, so that one's looking good. Hero MotoCorp is not too far behind. You have Cipla, Axis Bank, Apollo Hospitals, SBI Life, Adani Enterprises and Grasim that are topping the charts this morning. On the downside, it's IT yet again. So a lot of cautious commentary coming in from, several brokerages about the IT sector. Infosys, TCS, under pressure. Tech Mahindra is also under a bit of pressure right now, and something like Hindalco is coming in for a little bit of profit taking, down 0.8%. Apart from that, consumption is taking a bit of a backseat this morning. Tata Consumer is down about 0.5%. You have a couple of other names that are also a tad bit in the red, and Reliance is dragging its feet down about 0.3%. But there are plenty of stocks in the broader market that are looking quite good actually. So I'm going to hand it over to Surbhi. But for now, the advance decline ratio is well in favor of advances. So at least the market breadth is positive at the moment.
It's a very quiet start even for the mid-cap markets. This is a slightly different market than what we've gotten used to sort of seeing, because mid-caps are also taking it slow and steady. You don't have immediate high flyers, to begin with. Some names like Varun Beverages are cropping up on the charts. It's 3.5% up on Varun Beverages. There's Poly Medicure, which is up 3% in early trades. SJVN is coming right up. V-Mart is seeing some traction thereabouts. Let's look at Spandana. It's up about 1.5% right now. KFIN, by the way, has withdrawn its application with the depositories. Stock's down about 2.5%. Persistent has that negative note from Ambit today. That stock's down about 1% as well. but no dramatic moves in either direction, neither up nor down. On the volumes chart, stocks that stand out right now would be perhaps KRBL, BLS, L&T Finance Holdings, but then these gains are just 1 to 2%, so to speak. And Varun is the one that's really in focus on both price and volume action. Otherwise, mid-caps are taking it very easy. Mid-cap index is just really trying to hold on to the green side, whereas the Nifty is now seeing slightly deeper cuts. The bank Nifty is down about 0.2%. So you've got banks down, you've got IT down, you've got Reliance down. That's not a great combination for the bulls because your three large pockets of the market are trending on the softer side. Pretty cautious, Prashant, from what we can see right now.
Yeah, 20 points lower, right? So it's a flat kind of a start. 18,740 is where we are at. I mean, look at the Nifty Bank as well, which has been the more ranged kind of the two indices. It's starting about 0.25% lower, which is what 100 points in the Nifty Bank, which means that we are kind of, going below the 20-day. We left off within 3 points of the 20-day moving average, but right at the word go this morning with a 100-point cut, there's a bit of a downtick which is coming there. It's been treading water now for the last 4 days around that level. Now, Zomato sold off 6% yesterday on decent volumes. It's down another 1% this morning at start. Infosys is down 1%. It's coming up with very large volumes, so keep an eye. Anantraj Industries is another one, which is down about 2 1/3%. And Tata Chemicals is another one. So, was a 4-digit stock till day before. It's now at about 960 with another 1 1/4% cut. It lost some ground yesterday as well. Maybe look at GHCL, which is the pure soda ash company out of the two. Tanla Solutions has had a very large run, so there is, I think, some profit taking there. 1.5% lower, just highlighting stuff with volumes. And of course, Suzlon has been is done very, very well, and that is down as well. Coming up with volumes, APL Apollo is down about 2.5% as well. Sangam Industries, we highlighted this in the morning as far as the blocks are concerned. Vivek highlighted that is down about 1.25%. It had a very, very large move yesterday and has done very well. I mean, 2nd of June, the stock was 230. It's at 330 today. So it just, 7 or 8 trading sessions, Sangam Industries has done that. So, and of course, yesterday's block deals data indicating that there are some large, well-known investors in the name as well. Rain Industries is up 2.5%, some stuff on the upside as well. Fact had a very large day yesterday, so that is up another 5%. You got SJVN, which is up 2.25%. I think we highlighted that. Adani Total Gas is up about 2.5%. And V-Mart, there was a blocks data. We highlighted this in the morning. Amansa, which already owned 7%, has picked up some more shares yesterday. And V-Mart, which has been a huge underperformer, is starting about 3% higher. Some of these diagnostic chains as well. Metropolis with a 3% gain, 1343, 1345. So keep an eye. But 30 points lower on the Nifty, Sonia.
You were mentioning Metropolis. All of these hospital companies are sitting at fresh highs today.
Yep.
So whether it's Max Health, Global Health, which is Medanta, Narayana Health, all of them at fresh highs. And all these stocks have given you 30-35% returns this year. So, I mean, of course, they're doing better business, hopefully. You never want to be a part of their business. But in any case, I mean, for their shareholders, always a good thing.
Absolutely. And by the way, Narayana management joins us as well a little later on the program. So we'll put some of that to them. Imagica, which is, of course, is up about 8% or so, 52 rupees, is coming up with some volumes as well this morning. So we'll see how this goes. But right now, it's absolutely flat kind of a start on the indices. We have Pankaj Tibriwal now joining us. He's Senior Executive Vice President and Fund Manager, Equity at Kotak Mahindra Asset Management Company. Pankaj, good to have you with us here. Thank you very much for your time. It's been a feverish and a frenzied move in mid-caps and small-caps. Portfolios are looking green and, I was talking to some PMS fund managers, monthly gains, at least the last two of 7, 10, early 2-digit gains, monthly gains. So it's been fantastic. But what from here, Pankaj? How are things looking to you?
Good morning, Prashant. Yes, absolutely, you're correct. This calendar year to date, if you look at Nifty has returned about 3.5%, whereas mid and small caps have given about 10% odd returns. And stock specific, there are many stocks which have given 30 to 40% returns. So it's been a very strong move. And there's a reason to it that the earnings on the non-BFSI space, which largely comprises of mid and small caps, and if you look at the NSE 500 companies, 421 companies on the non-BFSI space have actually delivered better than expectation. If you look at the first 9 months, they were down about 9%, mainly led by oil and gas and metal and mining. But in the last quarter, due to the margin expansion, we saw that decline getting arrested to about 2%. And if you look, and if you remove metal and mining and oil and gas, actually there was a high single-digit earnings growth for the remaining non-BFSI pack. Also important to note that markets are smarter than all of us. And time and again, we have been talking about cash flows. And when we looked at the balance sheet and cash flows of corporate India, they have done an excellent job. 245 companies of the 421 non-BFSI companies have actually improved their working capital and cash flows in FY23. And now corporate India, the NSE 500 companies, have seen their ROE move to 14%, which was in 2019 at about 10%. And so has the valuation re-rated. And just to recap, now over the last 5 years, NSE 500 companies have delivered 18% CAGR on earnings, and so has markets responded. So I think over the medium to long term, markets are slave of earnings. Going into FY24, we believe that profitability on margins could surprise us positively. But on the top line growth, one should be a little careful because last 3 years, corporate India has benefited from inflation. Now, if you look at yesterday's number on WPI, second consecutive month of negative WPI numbers, which could weigh on the pricing and volume growth will be equal to top line growth. Whereas when I look at the street expectations, street is slightly higher on the top line growth. So this year will be more about improvement in margins and profitability and less on top line growth, which was just a reverse last year. So I think there are pockets of opportunity over the medium to long term. But in the very near term, we believe that markets are fairly valued. The undervaluation is very limited out there, and we need to be a little careful not to get carried away on momentum stocks.
Absolutely. Pankaj, many pockets are doing well. So just wanted to take that point forward in terms of individual stocks as well. Just want to pull some of them up. Fortis Health is now up almost 2.5%. KPIT Tech is actually bucking the trend we've seen in the mid-cap IT space, up about 2%. Something like a Marico is up 2%. KRBL is looking good. So a lot of individual stocks still doing well despite the market being flat. But Pankaj, talking about IT, right, there are multiple reports coming out which indicate that growth has slowed down across pockets, whether it's BFSI, and even, some of these short cycle deals are seeing either cancellations or deferrals. What do you do in the IT space now? Do you stay away entirely or do you look to buy the dip?
So the structural story on IT cannot be debated. I think we have a long runway for growth for the Indian IT services. But in the near term, absolutely, you're correct that what we are also picking up from our channel checks is that cancellations have picked up, especially on the BFSI space and discretionary space. And the next couple of quarters could be slightly painful from a revenue growth perspective, though margins could be still better than what we have seen in the last year because attrition levels are down. But don't forget that somehow the markets have factored into that. In the last 18 months, we have seen absolute price correction and valuation correction in IT companies. And from, overall contribution to overall profitability, IT sector moved to about 13-14% of the India Inc. corporate profitability pool. That is now down to about 9 to 10%. So I think if you take a 2-3 year view, I think next 2 quarters could provide opportunity to start increasing your IT exposure. And we are looking at such opportunity, and especially on the large cap IT names, we are seeing that valuations have meaningfully derated. And if earnings growth pick up maybe after 2-3 quarters, you could see opportunity like that.
Okay, got that. Pankaj, hi, good morning, Surabhi here. So we know that as a house, Kotak has been extremely bullish on the manufacturing revival story, right? And I believe, some of the themes like cement are a part of that. Perhaps, in the large cap space, you could look at capital goods. But I want to find out from you that when you're talking mid caps and small caps, then how do you play the manufacturing revival story, beyond the ABBs and Siemens and L&Ts of the world?
So, structurally, we are positive on the entire revival of manufacturing, and this time it looks real. And when we analyze the previous cycles, we believe that the cycle lasts for anywhere between 5 to 8 years. In our view, we are in the second or the third year. And normally in the previous cycles, we have seen that margins double, ROEs triple, and valuations actually quadruple. Though on headline valuations, most of the stocks are looking expensive. BSE Industrial Index has seen a sharp run-up, about 42% on the last 12 months. And most of the stocks are at near all-time high. So maybe in the short term, it may take a pause. But when you look at slightly medium to long term, BSE 500 companies for the first time have touched the 7 lakh crore mark. So government was doing the heavy lifting. Now private sector is joining the bandwagon. And the household, which is nothing but real estate, continues to do well. So all the three engines continue to fire. And we believe that large part of the manufacturing side lies in the mid and small cap space. Whether it be the short cycle plays like bearings, abrasives, whether it be the entire home improvement space to ride the real estate cycle, or whether it be the manufacturing, which is cement, chemicals, and some of the other pipe making companies, and so on and so forth. So I think it's a large, pool of companies and universe to select from. And we believe that over the next 3-5 years, manufacturing and the industrial capital goods cycle has still more legs. Just giving you a caveat that in the short term,
Sure.
there's a probability of a slight underperformance due to valuations.
Got that. Pankaj, since you mentioned chemicals, there's a question on my mind that of late, data has started getting a little patchy, and this is also one sector where there's a huge amount of global exposure. So you are, pretty exposed to global cyclicality of demand-supply cycles. So will that still be a go-to space for you, or are you increasingly getting cautious? How are you cutting up the chemical space?
So Sulbi, last 6 months back, we had a cautious view on this sector, saying that valuations have run ahead of fundamentals. And over the last 6 months, we have seen that sector consolidating. And in the near term, we believe softness will continue, led by decline in end product prices with the reopening of China. But however, if you take a slightly medium to long term, I think this is one sector where India has the right to win. And we have seen over the last 5-6 years how in the overall large pool, we have increased our market share from 1% to about 4%. So in the near term, we believe that there will be softness, there will be weakness, and that's what the stock prices are showing. They are consolidating. But if you take a 3-5 year view, these dips will be presenting itself as an opportunity to increase exposure whenever it warrants to. So from a medium-term perspective, we are quite positive on this space. And there are many companies which have shown that if you want a substitute to China, nonetheless, India is presenting the opportunity. So I think one needs to, kind of adjust the time horizon, but structurally quite positive on this theme. And this also forms a part of our manufacturing thought process.
The other space I wanted your thoughts on, because you started the discussion by saying that, the earnings recovery has largely been margin-led this time around, is the FMCG space, right? As we speak, names like Britannia, Nestle are all sitting at lifetime highs. And for Britannia, I was going through the earlier notes on what led to this margin improvement. It was almost a 700 basis points gross margin improvement this time, year on year, in Britannia's Q4 numbers. And now the stock is at 5,000 rupees. Is all the good news priced in, you think, Pankaj, for names like Britannia, Nestle, or do you think there is more to go given this margin outperformance?
Absolutely. We have seen a very sharp move in some of the FMCG names, and valuations are somewhere full. Though the margin expansion will continue, but I think markets have priced in already. And if you remember, Sonia, a few months back on your channel, we kind of talked about this gross margin expansion as one of the themes. and it's played out to a larger extent on FMCG. But I think it's still yet to play out in cement. And we believe that in cement, the way petcoke prices have started to correct from $200, the latest shipments we are hearing is about $100, $110. And that will make sure that in the next few quarters, the profitability will improve substantially. Is that factored into by the market? We believe not so much. And there, I think gross margins will play a big role. Also in some of the industrial and cap good names where raw material and energy intensity forms a large part of cost, we could see positive surprise there on the margin expansion as well. But on FMCG, just one more tailwind that, last 2-3 years, volume growth has been really subdued. We are going into the election year in the next 12 months. And our analysis suggests that 6 months before the election and 6 months after the election, the money gets spent at the lower bottom of the pyramid, and there where the consumption actually picks up. So we have seen some margin tailwind already play out, but the top line growth, which is volume expansion, has still not played out. And I think that could be a story for the second half of this year in FMCG.
Okay. Got it. All right. Top line growth, that could be the story for the second half of the year. So more tailwinds perhaps for this sector. Thanks a lot, Pankaj, for joining in. Appreciate your thoughts as always. Well, if you're wondering what's been happening with the market, nothing at all actually. It's so quiet. The Nifty is just hanging on to 18,700 and the mid-caps are in a slightly better shape. But one space that's been buzzing is the hospital sector. According to a May 2023 Equirus Healthcare Tracker, there is strong interest seen in the hospital space when it comes to M&A and deal activity. In terms of deal values in the calendar year 2023 so far, investments in the hospital sector is leading the space. Sandhya J, who's the Group CFO of Narayana Health, joins us now to discuss more on this. Sandhya, thanks a lot for joining in. Of course, we'll talk about your business momentum as well. But first, I want to ask you, what is the reason for the sudden interest in the hospital space in India? And you folks have about 650 to 700 crores of cash lying in your books at Narayana Health. Would you be interested in participating in any of these deals?
Good morning. Thank you for having me here. I think during COVID, hospitals went through a cycle where initially there was a demand choke and then there was an overflow. And the cash flow positions of many of the hospitals significantly improved. And we also believe that COVID kind of made people far more health conscious. India is one of the most undertreated countries in the world, where people don't come. They feel that going to go for treatment is like a bad thing. So people don't do proactive checkups. People only come for a health issue when it's really very serious. So it's a very underserved market. And during COVID, the realization on the health consciousness, the realization that you should get yourself tested, I think that also increased. So there was some good traction coming in. And because hospitals had a reasonable amount of cash flow, so they started investing. So if you see, every healthcare institution is talking about significant capex and investment. So I think that's why this sector is getting so much attention. From our point of view, we are cautious on the M&A front. The assets are fairly high priced at the moment. We are an affordable healthcare organization, and every day we strive to bring the lowest cost or the most affordable cost for our patients at the highest possible quality. So when we have to strike that balance, we have to be careful about the choices we make in terms of our capital allocation. So therefore, while we are not averse to M&A, but we will be very careful. We won't throw money at a very high-priced asset because then we'll not do justice to the patients who walk in. We won't be able to continue to give them the kind of affordable care that we are giving them today.
Okay, Sandhya, hi, morning. So let's just explore that point further. You're saying you're going to be cautious when it comes to acquisitions. Do tell us, if there's anything interesting that you see on the radar. But more importantly, you also have a capex plan of, I think, slightly above 1,100 crores for this year. So will a bulk of that be funded with the 650 crores of cash that you have? What is the plan? Where will this capex take place? And really, essentially, what is the growth in the India business that you are hoping to see and hoping to achieve this year?
Yeah. So yes, we also have sufficient headspace in our borrowing as well. So depending on how we want to deploy the cash, we will make a judicious choice between internal accruals and borrowing. Last year, it was about 40-60. We spent 40% of our capex from internal accruals, and maybe we will maintain that kind of trajectory into the current year also. As far as where we want to spend, we want to first expand in our core markets, where we have a significant brand dominance, and we also need capacity. So in Bangalore and in Calcutta, we will acquire land. In Bangalore, we already have land available. So we will expand in Bangalore and Calcutta through Greenfield. But there is also a big chunk of capex that we are allocating to throughput improvement. So one of the things in healthcare is many times we believe that if I add more beds, which means I can process more patients, but that's not completely true. There are multiple places in which the flow gets blocked. It could be diagnostics capability, it could be OT capacity, it could be cath lab capacity, it could even be lab processing time. So we are also making a significant chunk of investment in improving or debottlenecking the capacity across the organization, more cath labs, more diagnostics, etc. That's the second chunk. The third chunk of capex will go into additional capabilities. For example, we are setting up oncology across multiple of our hospitals, bone marrow capacity. So capabilities which are white spaces in hospitals, that's the third chunk where our capex will go.
So this is not going in this new entity, Narayana Health Integrated Care, where you're doing, I think, home care clinics. This, the capex, 1,140 crores is not going in to set up the new entity. Is that right?
Very small amount of that 1,100 crores to start with will go into that new entity. Significant chunk will go into existing business to increase capacity and increase throughput.
Sandhya, hi, good morning. And I attest to your earlier comment about affordable care. I mean, I've been to the Children's Hospital here at Mahalakshmi, and so absolutely take that point, and it is true. So it's a strange question to ask a hospital, how do you plan to improve your margins from here after what you said? But since this is, investors, and that's something which investors are focused on. In the cost structure that you have, right? I mean, there is all kinds of things, consumables, there is, there's rental, there is, of course, cost of doctors, other manpower costs, some of the larger heads, really. What can you do? I mean, in FY23, your India EBITDA margins was about just under 18.5%. Would you want to guide your viewers, your investors, how this would be in 24 and beyond?
While we don't guide on margins, but I can explain how we're thinking about it. So we've not passed on the complete pressure of inflation onto prices. We've taken one of the lowest price increases, I think, in the market. The reason being that we believe that we have to walk an extra mile to keep our services affordable for our patients. So, which means that there is a huge inflation burden that we've taken on our P&L. We very, very strongly believe that we have enough headspace in our operations to be able to cover up for that, which we have not passed on price, the inflation. But it will take some time. The salary increase hits you on 1st of April, but you will take some time to neutralize it. So we may see slight dilution of the margins in the initial quarters, but we will come back. But I don't think we are aspiring for a significant margin expansion, because we believe that even we will deliver efficiencies, but we will also pass on efficiencies to our patients on a continued basis.
Okay, we are running out of time, so I just 2-3 very quick questions, if you can answer them for me. The promoter currently has about 64% stake. There is no intention to sell stake anytime in the future?
Not at the moment.
Okay, got that. The other thing also, the cash on the books is 650 crores, and you were talking about how you will look to deploy it at some point in time. Will your expansion of this, will your deployment of this cash largely be organic, or any inorganic moves in 2023 lined up as well?
Like I said, we will be cautious. If there is a meaningful inorganic, we are not averse to it, but it has to make sense to us and to our patients. So we will be open to inorganic, but at the moment we are envisaging a significant organic deployment of the cash.
Which have happened recently, which I'm sure you guys have been watching. Are they quote unquote reasonable, Sandhya, or too expensive?
Pardon me, I missed your question.
No, all the deals which have happened recently in the space, have they happened at sort of levels where you're comfortable with, or they're too expensive? Is the market in the deal space too hot here right now? So valuations, of course, are high.
It is hot, we would say. It is hot. That would be our view.
All right, Sandhya, thanks very much. Good speaking with you, and keep doing the good work. Thank you very much for joining us here on CNBC-TV18. We'll take a quick break here with markets, which, by the way, are up about down 25 points, nothing at all. I mean, we're basically where we started at 9:15. 18,730 is where the index is now trading. And we are back with the management of Suryodaya Small Finance Bank to discuss their business outlook. A little later after, we'll also have Rahul Bhasin, managing partner at Bearing Private Equity, to discuss what else but the deal space, blocks after blocks, and the market looking very good. So this is a market for M&A. Stay tuned. That conversation coming up.
Welcome back. Market's not doing much. Just one stock, IndusInd Bank, is pretty, evident in the kind of pressure that's been building up on this. It was the poorest Nifty performer yesterday. Again, it's down about 1.5%. Anyway, banks are lower, but IndusInd is the weakest link on the Nifty, at least as of now. Well, let's continue with the conversations then. Suryodaya Small Finance Bank is on our radar. The company's engagement with investors in the past few weeks has only increased. Suryodaya Small Finance Bank posted quite a robust fourth quarter, and it was a pretty strong guidance that we got from the company as well, 30 to 35% growth on the credit front. Okay, India's market capitalization hits the highest in rupee terms. This is the BSE market capitalization that we're talking about, and we have hit the highest now. The earlier record, of course, was 291 lakh crores. So moving from strength to strength, though the headline indices aren't doing much. But, well, that's good news to happen. That's good news to have, considering the kind of wealth creation that we've seen in this short span of just the last 2 months. April and May absolutely blow up.
The thing is that the Nifty, right? Nifty 50 stocks, they're almost at new highs, for all practical purposes.
Yeah.
But the fact is we're not crossed it, right? Yeah. Now, Nifty 50 would be roughly, from what I remember, 90% of the overall market capitalization. This almost 300 lakh crore, 90% would be just Nifty 50 companies. So the fact is that market cap has crossed the previous highs.
The index is not. Is struggling.
Because, and that tells you the rally which the stocks outside the Nifty have seen.
Yeah.
And how much they had to rally to take the overall market cap above, the previous peak.
Also, if you compare it to the global arena, India has now resumed 5th place in the global arena in terms of highest market cap globally. So first, it's of course US, China, Japan, Hong Kong, and then the Indian market. It ceded some share from France.
That's really nice news to have, considering we've just been waiting to get that one headline of index at all-time high. We don't wait for the index. The market capitalization is at an all-time high. So yes, we are in a good mood over here. Let's get to that conversation with the management of Suryodaya Small Finance Bank. Then we have Mr. Bhaskar Babu Ramachandran, MD and CEO, joining in. Mr. Ramachandran, thanks very much for being with us. Your guidance has been extremely strong. I think it's 30 to 35% growth from what I remember. That's credit growth that you're talking about. But even if I look at ROE, you're guiding for 18 to 20% growth in ROE by FY25. You're also meeting a lot of investors. Just trying to figure out, are you at all looking to raise any fresh equity capital? Or are you looking to get any new institutions on board at all?
Thank you. Good morning. So we aren't really looking to raise any capital, considering that our capital adequacy is pretty high at 34% at this point of time. Even observing for the growth of 30%, which we guided for this year in terms of assets, we still be in a very comfortable capital adequacy. And our PPOP, as guided, was around closer to 37 crores last month of the Q4. And continuing that, we are really looking at something like around 500 crores of PPOP for the year, considering that we do not have any immediate plans to raise capital. However, where there is any opportunistic possibility of raising capital, which is good in terms of making robust, we will.
Okay, so you're not looking to raise any fresh capital, at least in the immediate term, you're saying. So do give us a breakup of the guidance. I mean, 30 to 35% credit growth over the next 2-3 years. But where will this come from? Which segments, which geographies? Describe the lay of the land to us a bit.
I think across the industry, the microfinance industry is expected to grow anywhere between 15 to 20% consistently for the next 3 years. On the back of it, we are looking at around closer to 20% growth. We do not have deep penetration in some of the states we have been operating for long. During the COVID period, we didn't really expand. So considering we will don't enter exactly, deepen some of the geographies where we are present, which include Uttar Pradesh, Rajasthan, Karnataka, Madhya Pradesh. The growth will come on back of that. Also, we are looking at graduating our JLG customers into individual loan customers. Played out pretty well last year. We currently have a 1,200 crores portfolio. The intent of that is to make sure that the customer becomes a holistic banking customer with multi-relationships, not just lending. For 1,200 crore portfolio, 2 lakh customers at this point of time. We'll add another 2 lakh customers from our existing base. And we're also looking at acquiring new-to-bank customers in the Vikas loan product, which is a flagship product, and bundle it with a few other very critical products like PMJJY, PMSBY, to make it comprehensive offering for the customer individually first and thereafter the household. Fairly confident that we're headed for a 25 to 30% growth over the next 3 years.
This Vikas product, how is it done in the first 2 months of this quarter?
Consistent as it was. We do around close to 50% of our overall inclusive finance disbursement Vikas loan. We do not want to accelerate much more than that. It will be a slow process. But currently, we are acquiring around closer to 25,000 customers in that. So on that basis, we are likely to end up with closer to 4 lakh customers at the end of this financial year.
What is the AUM at the end of May in this product?
So, as of March, it was 1,200. Likely that it will be closer to around 2,000 crores at the end of this year.
Okay. Mr. Babu, I wanted also your thoughts on how your business mix is expected to change over the next few years. So, just for the benefit of our viewers, over 60% of your business comes from MFI loans, followed by, of course, CV loans, small portion of it from there, then a small portion from housing loans as well, about 10% or so. Would you be looking to sort of reduce your exposure in the MFI segment, increase in other segments which are rising, like perhaps CVs, affordable housing, etc.? And what will the loan mix look like 1 to 2 years down the line?
The growth in the non-MFI business, which includes affordable home loan, secured business loan, commercial vehicle predominantly, will be a little higher than the microfinance portfolio. So with readjustment, we are not slowing down growth in the inclusive finance segment, but however, the growth within that would come in from Vikas loans. And we are covering majority of the Vikas loan under credit guarantee scheme called CGFMU, which makes it, if not fully secure, quasi-secure for taking care of the one-off events which happens in the industry once in 4 or 5 years. There is an event which creates a credit loss of closer to 7 to 10% on the industry level. So we want to protect that. We are investing in that, I would call it, rather than a cost. This year we'll cover closer to around 80% of our inclusive finance portfolio under the credit guarantee scheme. So the ratio will be 55-45. We're fairly comfortable. In a couple of years' time, it is likely to be 50-50. And will continue to be a solid financial inclusion player. So which means that inclusive finance will contribute around 50%. Majority of it will continue to be business loan and secured in nature, but covered by the credit guarantee.
So in these pockets like affordable housing and commercial vehicles, since you're planning to scale that up as a portion of your overall business, can you help us with what the growth rates could be over there, both in affordable as well as commercial vehicle?
Both of this at the AUM level, given that they are long annuity products, would be closer to around 40% in both of this, both in affordable loan, secure business loan and commercial vehicles.
Okay. Mr. Ramachandran, want to speak about margins a bit as well, because I think in the fourth quarter you were at a pretty robust level of 10% plus. I think it was 10.4, if I have the right numbers. So now what happens from here on? Because there's a general expectation that this is the peak of margins and we'll see margins cool off. So give us your view on that. And obviously, when we talk margins, we also have to discuss your cost of funds and then therefore your deposit franchise. How much are you looking to grow deposits to fund the kind of growth that you outlined earlier?
Deposit growth, considering that the base is not very large, would be around closer to 40%. The focus on that always for us has been in terms of granular deposit. 80% of the deposits are less than 50 lakhs in terms of relationship value. Likely that it will be the same range or inch a little more. So we are focused on that, and the growth hence would be around closer to 40% for this financial year. And
so what would the credit deposit ratio be, sir? Just to understand, what is your credit deposit ratio now, and where do you hope to take it to?
It's around closer to 115%. It will go to around less than 110 during this financial year, and the intent is to take it to 100% by FY25. However, the gap between these is funded not by any short-term loans or other borrowings. They're all funded only by refinance from NABARD, SIDBI, Mudra at this point of time.
Okay, we'll leave it at that. Mr. Basu, thanks a lot for joining in. Mr. Babu, sorry, thanks for joining in, and I appreciate your thoughts to talk about the FY24 outlook. By the way, the market may be flat, but there is so much action beneath the surface. Don't lose sight of that. Some of these fertilizer stocks are starting to move in a big way. FACT is up almost about 8% hospital stocks are just on fire. I mean, okay, I don't want to say that actually. Doing very well. Let's put it that way. Something like a Polymedicure is also up almost about 6.5%, doing well there. Britannia is at a fresh high, so lots happening in that space.
Absolutely. And, activity is, can't complain at all. Broader markets, that is. Now, Rahul Bhasin is joining us now, managing partner at Bearing Private Equity. He's with us to talk about what he's seeing. The market is very perceptive of larger trends, themes, and of course, some of it, makes it into the portfolio at Bearings as well. Rahul, it's a pleasure. Great to have you with us here. Thanks very much for your time.
My pleasure entirely.
Do you have a view of on market levels, Rahul? Let's just get that out of the way. In terms of whether we're too expensive or are we fairly valued. We had a mutual fund manager who was saying that near term, there are very few pockets of undervaluation left now. We had Prashant Jain of ex-HDFC yesterday who said something very similar. So I just wanted to get that out of the way. Any thoughts?
Yes, I mean, that's probably true. I think the markets have become a lot more efficient now than they used to be. I mean, historically, today almost, if you look at the financial savings of the country, almost 7% is going into mutual funds now. People who are used to a scenario where 1.5% was going into mutual funds are used to a scenario that no matter which market you always had some pockets of undervaluation or mispricing given the current interest rates. I think the game has changed a little bit, and I think that we've got to anticipate what the discounting rates are going to be and what the structure of the market is going to be at least 18 or 24 months out, and then look at where valuations stand. I think this whole sort of thing of at today's pricing that one would get a serious undervaluation, I think that's a bit of an optimistic wish list. Especially now that you have so many algorithm-based investment themes going on, which picks out undervaluation and systematically invests in even unknown names. So, you're bound to have a much more efficient market in that sense.
That has become harder, isn't it? Compared to even 5-6 years back. Because you want to go back even further. It's a different market, absolutely. Rahul, there's one large space, I don't want to say they're undervalued, but which is relative to their own valuations and prices is still lower. IT services. You have investments in IT services. You guys have been investors in mid-cap IT services for a long time, for the last 15 years or so. What is the space? 25. What's the call, Rahul, there, that space? Do you think one gets to make a lot of money investing, buying here? Go on.
Yeah, look, these are all very well-run companies. I think the first thing you look at IT services, that they're all very well-run companies. The governance architecture tends to be very good. Their systems and processes are really sound. I think the market's concerns are twofold in my view. The market's concerns all come from the fact that you are expecting a US slowdown, possibly a recession, possibly in other parts of the world. One has seen the latest data suggesting even China is slowing down, which means the globe is slowing down sharply. And then there tends to be a sort of a leveraged impact on IT spends, and therefore I think the market's concerned about short-term impact on IT service businesses in India. And the other thing I think the market's worried about is that the entire generative AI, etc., they think that possibly productivity might rise significantly And if productivity rises and you have, time and material kind of model, which is still widely prevalent in the IT services industry, whether in fact work might come down in the short term. But if one looks through that entire ecosystem and one looks, 5-10 years down the line, you look at all the structural changes of how core IT is becoming and how, almost every business is run out of an IT backbone, you'll find that this IT services business will come back quite strongly. So if you have greater than 3 to 5 year sort of horizon, I think, all these businesses are steals in that sense. But in the short term, I would expect pain.
Sure, got it. So you're saying with the long-term horizon, there's nothing much to worry about in the IT space. But I want to come back to that point you made about generative AI tools. And we were doing some research, found that a lot of companies in the listed universe are spending big on generative AI, whether it's something like an Apple or Intellect Design Arena, LTI Mindtree, Persistent Systems, and a lot more. I mean, I guess that's the need of the hour. Which are the companies you think could make it? Which are the companies that would have to perhaps see losses? And how are you feeling about this space in general, the generative AI space?
Look, I think it's a fundamental change in architecture. It's like saying, you now have internet, or I think this is going to change productivity across businesses. And especially of knowledge businesses, productivity is going to change very dramatically. So I don't think that this is, will it kill some jobs? Of course, it will kill some jobs, but it will generate far more ultimately. And it's going to create a lot more wealth because of productivity. In fact, I think the world is suffering from this inflation hangover. I think it might be generative AI which solves for this issue. And which companies will succeed? Actually, there are a lot of companies in the private space that we are engaged with in one form or the other who've been working on this for a long time. I would only suggest that, this has caught the market attention in a wider trend today, but the companies are going to do well in this are those who were making investments and working on this at least 5 years ago. The rest will be playing catch up. And even if you're playing catch up, I mean, I think every business across every sector can use the productivity gains that these tools offer.
Sure. Rahul, hi, morning. So, to just complete the technology conversation, let me marry technology where you already have several holdings and consumer. I mean, you have some of the regular FMCG companies, like I think Dabur, Godrej Consumer, Nestle. I think these are some of the portfolio holdings. But what about consumer technology? I mean, I would just want to get your sense on what you've made of this last 1.5 year journey of all the aggregator platforms, right? Now, whether it's on the food side, on the beauty side, or the payment side for that matter, what you made of the public market journey, where valuations are now, and whether at some point in time this space would interest you at all.
I think you're thinking, are you sort of alluding to the Paytms and the Zomatos and the
Absolutely.
Nykas of the world? Okay.
Absolutely, Rahul.
Look, it's not that I think they're actually solving for a real problem. There's a market discovery taking place. There's a network impact. All of those things are there. The real issue has been that in India, the number of consumers, if your cost of customer acquisition is so high, the sad truth is that the consumer surplus that customers have in India tends to be small. So the amount of time it takes to actually get economic payback on acquiring that incremental customer is challenged. Now, historically, markets have rewarded very high growth of the top line, and therefore those are the strategies these companies have adopted. But I think that on the margin, they might be trying to attract the customer, which is not economically viable at this moment. Now, the customers will become economically viable over a period of time. And I think that's the challenge that these businesses are facing in terms of being able to generate current income and current earnings. So a lot depends on how they approach this. I think if they were to slow down and sort of, stick to acquiring viable customers and grow, in terms of how, one is acquiring customers, India has a huge population base. But I think this distinction, if they were to manage you would get better economic entities out of it and more attractive from an investor's perspective.
Rahul, I remember you used to own sort of jumping sectors, Manappuram. I see you own Muthoot as well now. After
we used to.
Sorry, you own both now or one?
We used to own both. I think we're largely out of both of them. We have a small tail position in Manappuram still.
Okay, so my question disappears then. These, in terms of the capacity, capex kind of sectors, I think you still own a couple of contractors?
We had a company called TD Power for many years. We've just recently divested it, but I think we think the capex cycle.
Anything in the space, manufacturing space, and it's very vast. But anything you own there?
PG Electroplast, which is a company which is you can think of it. I think from the market's perspective, you can think of it as Amber sort of clone, but growing 4 times as fast as Amber.
All right. I think, we could have gone on for a bit more. We got more questions, but no time. So Rahul, we'll request you to come back soon and talk to us. This was just getting interesting. PG Electroplast is a stock Rahul was talking about from that space, but I'm sure there are more. Rahul, thank you very much for joining us and talking to us about what you like and how you're thinking about markets overall. We'll take a break here. Mitesh Thakkar will be with us with more on the other side. We take stock of markets and fresh trade. Stay tuned.
Welcome back to Bazaar. Well, a lot of milestones actually being hit in the market right now. I just wanted to bring Britannia on board. It's actually a milestone for Britannia. It's crossed that figure of 5,000 rupees for the first time. It's an all-time high. And in fact, a lot of consumer names, whether it's ITC, Britannia, Titan, Godrej Consumer, all sitting at fresh all-time highs this morning. So pretty good there. Mitesh Thakkar is joining in. Let's get a view from him on this. Mitesh, first on Britannia, is there more to go on the upside here? And anything in this consumption space that you like?
Yeah. So I think, in fact, it's the stock-specific basis where the action is happening. We have had buys in Godrej Consumer earlier. I think that's done very well and it's made a fresh high yesterday only, I think. And HUL, the pattern is positive, but it needs to clear the earlier pivot of 27.25. And we've also had buyers in Dabur, I think, in the last few days, which has moved up. So the space is enjoying definitely from a short-term chart, on a short-term chart basis, good trading momentum. On the stock side, I have a buy on Lupin right now. Keep a stop at about 820 levels. Look for targets around 855 to begin with. And eventually, I think, we can pencil in some higher targets as well. And PVR Inox is a buy as well, with a stop at 1463 for targets of 1550.
Okay, got that, Mitesh. Thanks very much. We'll connect with you a little later on to see how the day progresses. So green on the screen, 18,780 for the Nifty, and the mid-caps are doing really well now. Well, speaking of mid-caps, let's focus on one of them, that is PNC Infratech. There's some buzz around the company. We've got Vivek joining in to explain why the stock is rallying almost 5%. Vivek?
Well, good morning. So it's actually a newspaper report that's come out today. So what this report indicates is that they say that KKR's road platform, which is Highways Infrastructure Trust, is in talks with the company to acquire a portfolio of 12 road projects, and the enterprise value of these assets is pegged at almost 9,000 crores. The portfolio actually comprises 11 hybrid annuity model roads and 1 build, operate, transfer road. We also reached out to the management of PNC Infra. They said that they would not like to comment on anything at this point of time. IIFL has come out with a note on this particular news report that's come out. What they're saying is that the enterprise value of the deal is pegged at 9,000 crores. So the deal actually translates into an equity value of 2,100 crore, given that the assets have a debt of close to 6,900 crore. So what they're saying is that at the indicated valuation, the deal would present an incremental value of 20 rupees a share for PNC from the earlier assessment that they had for these assets. And also what they say is that PNC continues to remain one of the top picks in the sector. Remember, if the deal fructifies, it will be one of the largest road assets deals that we've seen as far as the India infrastructure space is concerned.
Okay, thanks a lot for that, Vivek. Appreciate it. PNC Infra, big mover over there. Let's slip into a quick break for the market. Not too much happening, but all the action is in the mid-cap space, so do keep your eyes peeled over there. On the other side, our special segment, it's the economy. Lata Venkatesh will connect with Robert Sorkin, the global economist at Citi, and Aditya Bhave, the senior economist from Bank of America, to discuss all about the Fed's hawkish pause and its impact across markets. Stay tuned.